Hello and welcome to the Homebuyer Workshop with Full Service Mortgage Group, what you need to know before purchasing a home. We're excited to have you here, and hopefully this information will allow you to feel empowered throughout your home buying process. All right, so you've decided to purchase a home. Let's talk about it. What can you afford, right? That's the first real milestone to figure out. Most realtors want a pre-approval prior to taking you out to see homes. And the first step in that process is figuring out how much can you afford as a household. So here's the things that we look at to see if you're pre-qualified to go looking for a home. It's determined based upon household income, the amount of debt that is carried, how much have you saved for a down payment, or if down payment assistance is necessary, what your current credit score is, and is there a need to work on your credit in order to get you into a different product or maybe a different interest rate, and the location of the home. So let's talk about credit, which is really one of the most impactful parts of the process. Lenders use your credit score to determine your credit worthiness and whether or not you qualify for a home loan. It also determines what type of interest rate you can get. So the better the credit score, the better the rate. A couple of ways to improve or maintain your credit are to get a copy of your credit report and take a look at it. That's really the first step. If you don't want to do that by yourself and you'd like to work with me, I'm more than happy to help you in that. Typically, we do a soft pull to see where you're at, see what areas we can maybe shore up in order to get you into a better interest rate. But you do have access to a free credit report every single year. One of the other ways that you can increase your credit score is by paying off delinquent credit. Another way is looking for discrepancies or errors. One of the things that I come across is past maybe delinquent accounts can be reporting multiple times on your credit. And so that is something to definitely pay attention to, and we can catch that when we go through your credit report and discuss with you how to get those removed or taken care of. And oftentimes those, when you deal with things like that, it can increase your credit score by 10, 15 points right off the bat. Want to make sure to pay those bills on time, especially mortgages. Do not be late on your mortgage if you can at all help it. A 30-day late, you generally can be allowed one. Some products allow one late, but oftentimes even one late is problematic. Definitely want to keep those credit balances low. The kind of secret sauce threshold is 20% of the allowed credit. So if you are allowed $10,000 in credit, you want to keep your balance at about $2,000. So let's talk about saving and the importance of saving and why you need to save when you're looking at purchasing a home. There's a couple of costs that you would be responsible for. Number one would be your down payment. Number two would be home inspection. We're going to talk about these as we move forward, but there are some upfront costs, including closing costs. So it's never too late to start saving. You're going to save for your down payment, which can be anywhere from 3 to 3.5 to 5% or more, depending upon your particular situation. And then you're going to be saving for your closing costs, which typically are between 2 to 5%. We do have down payment assistance programs, and we can talk about that a little bit more as we go through your particular scenario. All right, so after we've checked your credit, saved for closing costs and a down payment, it's time to decide where you want to get a loan, such as which lender or broker. We want to give you the opportunity to understand your different lending options. Here at Full Service Mortgage Group, we are a wholesale brokerage. We'll explain a little bit more about that as we go. All right, one of my favorite things to talk about, how do I save money in my mortgage transaction? So let's talk about your different lending options. You've got a traditional bank. Most banks right now are getting out of the mortgage industry. It's just not as profitable for them, and they don't want to carry a loan note for 30 years. So what we're seeing is more of a shift toward brokers and retail correspondent lending. So let's talk about that a little bit. Now, on the broker side, we've got wholesale brokerages like Full Service Mortgage Group. What we do is we shop national lenders, hundreds of them, and each one has their own set of specific products. And as a wholesaler, our job is to match you with the right lender and the right product for the least amount of cost. And then the lender typically pays our fee. So what we do is we keep our overhead very, very low in order to pass that savings along to you, our client. One of the ways that we're able to do that is we don't charge excessive fees. We don't charge for processing typically. And the lender chooses how much to charge for underwriting because in our scenario, as a wholesale brokerage, the lender is underwriting your file. And what that means is it's a much more efficient way to go about the process because the lender knows exactly what they need to get your file cleared to close. So that's the wholesale side. Let's talk about the retail correspondent lender side. Now, sometimes a retail correspondent lender can also act as a broker. But the one thing I want you to keep in mind is most retail correspondent lenders, which they make up the majority of lending options, and that there's just a ton of them. But what I want you to remember is where there's a lot of them, there's a lot of cost. So think about it. Rocket Mortgage, there's a ton of them. They cost a lot to process a loan, to actually take you from application to closing. And oftentimes you get bounced around between person to person to person to try and actually get your loan to close. The other thing to consider is that a retail correspondent lender typically is much higher in fees because there's so many people involved in the organization itself. Their overhead is very high. Well, they have to make up for that overhead by passing along fees to cover that. So that is the biggest difference between a retail correspondent lender option and a wholesale option is really the fees. That's where you're going to see the biggest difference in your loan estimate. Now, the second way is that a retail correspondent lender is typically also selling their own money and then packaging it up and selling that to investors. So what I mean is they may be selling you a mortgage loan, and that's fine and that's great. But then what they're going to do is turn around and make money off of that loan by selling it to another investor. The other thing with that is that they're going to be limited on the products that they can offer because they themselves are acting as a lender rather than a broker. So that is kind of the biggest difference. So when you hear retail correspondent lender / broker, you're going to think overhead, fees. It's going to cost me something to work with them. When you think wholesale, what you're going to think is, hey, it's a slim organization, but they're small but mighty. And typically they're community-driven organizations like we are. And again, we're passing along the savings by keeping our overhead low. All right, so let's talk about loan estimates. This is really important. This is going to be the first piece of paper, other than filling out your application, that you're going to get from a potential lending source. One of the things that I want you to pay attention to right off the bat is where it says rate lock on the right-hand side there. You see how it says no and yes, and then it says until and the date and time? That is the most important part of this loan estimate right here. That tells you that this particular lender or broker has already locked this rate in and it cannot be changed. So that means the terms and conditions within this loan estimate are guaranteed. Now, one other thing to consider is the loan amount. Make sure that your loan amount is correct. Also look at the monthly principal and interest. One thing to note is on that monthly principal and interest, that does not include your taxes and insurance. You have the opportunity to choose who your insurance carrier is and the amount of insurance that you carry on your home. There is a minimum coverage required by your lender, but typically you get to shop who your home insurance is with, and that determines what that monthly amount is going to be. It's also important for you to look at that prepayment penalty. What that means is if you pay this note off prior to the terms of the agreement, this determines whether or not you're going to be hit with a fee to do so. In this loan estimate, there is a prepayment penalty. That is major. You do not want to work with a lender or a broker who has a prepayment penalty built into a loan. We do not work with lenders who do not allow, I'm sorry, let me take that back. We do not work with lenders who require a prepayment penalty. The other thing to look at is whether or not there's a balloon payment. This has to do with an adjustable rate mortgage typically, but it is very important to make sure that there's no balloon payment being added to your loan that you are not aware of.